What's up, everybody? Happy Monday. It's Austin at Origin Point. And the question that we get all the time is rates. Where are they heading? What are they? What's happening? So I want to give you 3 tactics that you need to know no matter what you're doing in your financing, whether you're buying a house, whether you're getting a car. The first one is, of course, the Federal Reserve rates and what that impacts. It is short-term debt, not long-term debt, right? So short-term debt, these are your credit cards, your lines of credit, your car loans, things that you're going to use on the short-term cycle. Long-term is looking at a different factor. Why is that? Because the Federal Reserve rate is where banks trade money at, right? So they're trading money on a short-term concept. They are investing on you in a long-term concept. So what do you watch when it's a long-term rate? Well, you watch the 10-year Treasury. TNX is that call sign. I like watching Yahoo Finance. I think it's very simple. So as the yields change, your rates will change, right? So if the 10-year Treasury is 4.3, but it was 4.1, that means that rates are increasing. If the 10-year Treasury is moving down to 4 from 4.2, it means that rates are decreasing. Why is that? Well, this is that long-term money. This is buying America for a decade at a time, and your mortgage is buying your house for a decade at a time. So think of it from that concept. So I want you to pay less attention to the Fed and more attention to the 10-year. What else is going to drastically impact rates is policy, right? You see it right now in global economic information, because policy is what impacts what we pay for things. Think of it this way. Taxes are a policy, right? There is a policy that you charge X to get Y. Like as your gas increases, that is a policy based on peace deals, right? So here in the state of California, it is estimated that if we don't come to a deal with Iran, we have 6 weeks of gas left. 6 weeks of gas, 6 weeks of gas left, right? Before we have to go to the global eras. And you think that $6 is expensive? I mean, we're talking 9, 10, 11. It could be banana pancakes. So policy is the most important factor when you're talking about how rates are going to be. So when you're talking about them overall, no matter where you are or what you're doing, these are the things that are going to impact you. What is the Fed doing short term? What is the 10-year doing long term? What are policy changes, right? Policy changes besides the peace talks are things like giving incentives to first-time homebuyers. They reduce interest rates for that. Giving incentives for certain programs. They reduce interest rates for that. Saying they don't want certain programs like investment properties or second homes. They're more expensive because back in, 2023, I think it was? I don't know. Gets a little blurry here. But the Federal Reserve told Fannie and Freddie, we want less second home and investment properties, right? So they made it more expensive. That is a pure policy concept. The more we understand about that, the more we can predict of where they're going to go. Now, again, this peace deal is the biggest thing on the table right now that's affecting things. So if you're curious where rates are going to be for you and what it means for you to be able to purchase in California or all along the West Coast, you let me know. It's Austin at Origin Point. Happy to help you. Make it a great day.